Hi, everyone. It's an amazing day to be here today. We've still got time. We've got 2 more minutes before 6 p.m. in my time zone. So, how are you all? Can I see your responses in the chat? Let me know if you can hear me loud and clear, and regardless of whatever time you're watching this, it's great to be here. My name is Coach Mo from Power to Know, and we will be doing justice to another subject matter following from what we started last month. Last month, we were talking about, I believe we talked about asset and liabilities, and today we are talking about asset allocation. So call your friends, call a friend of your friend of your friend, post it, let everyone know Coach Mo is right live right now. And we will be diving right in the next 50 seconds. Set the timer on. See, what we do here is we strip away all the grammatical noise, all the financial jargons you hear with words, and we try to explain them in terms you can relate to, you can understand, so that you really know what does this mean when you hear it. Not just knowing what it means, it's about the understanding. Because one of the things I do teach there is the ultimate goal is for you to take action. That is the ultimate goal, is for you to do something. But you cannot do things without coming from a place of understanding. It is understanding that makes that transition to application easier. However, there cannot be understanding without access to information required. It is the information you get that's been converted through comprehension that eventually gives you that understanding. It is when you have an understanding of a thing, then application becomes easier. It is when you understand, oh, so this is saving. This is what saving is. This is why I should save. This is the meaning of saving. So each time you're applying a particular thing, you understand the purpose of the why you're doing it. You're not just saving because somebody told you to save. You're saving because you have an understanding of what it means to save and why it is you're saving and what it is you're saving for. So it is for you to get to that place of application. We need to go through the journey of information, comprehension, and understanding. And when we flow through that stream, and when you understand exactly the reason for that, it makes application easy. That is the whole point of this. So today, hello everyone, welcome to Part to Know with Coach Mo. So I will be talking about asset allocation today. Asset allocation. Why asset allocation? Actually, let's backtrack and ask ourselves this question. What is asset allocation? Why should we care about it? We would hear the big guns. They would talk about assets, diversifying of assets and all of these things. But most importantly, what in simple terms, what does it mean? So I will take a step back again and say, okay, even what is an asset? Let's start with that. Let's come from the foundation of things. What is an asset? If you can remember, end of July when we're talking about asset and liability, and an asset is very simple, something that appreciates in value with potential of return. Simple. If I know this particular item has the potential to appreciate in value and provide returns, that is it. Simple. That is all we need to do. Hi, I could see people already in. Hi, V Brain from Abuja. ITT, I could see Bisaya from Leeds. I could also see Mrs. O. That is the Mrs. O of Coach Mo. It's good to see you tonight. Yeah, let me continue. Side distraction. But today, please, I will be checking in the chat box to see what you're saying. If you have any question, we're not going to rush tonight. If we have any questions at all you want to ask, just pump it in the search in the chat box. I will check in there from time to time. So we were talking about that. So that is what an asset is. An asset is something that appreciates in value. What that means there is, I'm getting this thing today because over time the value will have appreciated so that it will be able to generate a return, be it directly by the appreciation in value or indirectly by the dividends I'm actually drawing from it. That is what an asset is. We can use the big grammars and what they call it and to say that, but I'm not a finance student. I'm not an accountant. But one thing I understand there is I understand money and how money works. And I can tell you I have met broke professors in finance. So whatever discipline you are does not automatically means you have the understanding of that which you're mastering. That's what's important. So we know right now what an asset is: something that appreciates in value, or a store of value that appreciates with potential of returns in the future. That is it. Full stop. Bam. Now, what is asset allocation? Now, for you to talk about asset allocation, it simply means how you allocate different assets you have into different classes. We cannot talk about asset allocation without talking about asset classification. So what that means there is, in simple terms, the different types of asset classes we have. Like we mentioned, asset is something that appreciates in value. Now, there are different types of assets because they come in different forms and different ways. And it depends on who you speak to. Some will say there are 5 asset classes. Some will say there are 6. Some will say there are 8. Some will say there are, just like you never, that is not what is important. What is important for you is to get a good grasp of the main types of the classes we have. So I will break them down in this. I would say for the purpose of today, I will take us through the 6 classes of assets. Number 1, I'll be talking about today, I will talk about the one I'm going to call the cash and cash equivalent. What does that mean? This one is what is very, very liquid. And what we're referring to there is, this one is your raw cash, the money you have in your savings account, whereby you put it in savings accounts and Barclays, GT Bank, Bank of America is paying you 2% per annum, 3% per annum, and all of that. That is cash and cash equivalent. So that is the first asset class. Why is it an asset class? Because if you put the money in there and they pay you some returns over time, it's not the same amount you put in that you're going to get back. There will be a little bit of interest paid in the savings account. So that is very, very liquid. You can have easy access to that. That is the first class when we talk about asset class. The raw one, the very liquid one. What does that mean, very liquid? That means one that you can easily access, you can easily turn around and get your cash out of. Savings accounts, that is one. Cash in your wallets. Now, the second class is equity. And when we talk about equities, you hear people talk about things around stocks and shares and all of that. That is that second class we'll talk about tonight. Remember, we're talking about the asset classes because for us to be able to allocate assets, and what we're talking about is asset allocation, we need to understand the different classes of asset we have. The first one we talked about is cash, stays in its class. The second class we're talking about is equity. And when we talk about equity, we're talking about shares. I don't want to get into the technicalities of it in terms of stocks and shares and all of that. Basically, I'm talking about shares, stocks. And what does that mean? That is simply ownership in a company or a business. This means you take your money, you go to a particular company. I'll pick one from the air. You go to Amazon, you buy shares in Amazon. That means you own a particular percentage of Amazon. That is all it means. So you buy a share in Amazon. That is equity. The benefit of that there is when Amazon performs very well, the shares of Amazon goes up in value and you benefit from it. At the same time, if Amazon is not performing very well, the share of Amazon drops, because you own a percentage in the company, your share also appreciates and decreases at the same time with it. Now, when we talk about equity, see, there are so many things. It's a rabbit hole. So you can talk about things like ETFs, you could talk about index fund, you could talk about various things are packaged within equity. All that means there is very simple. It is an asset class that's got to do with shares in companies. That is all it is. Very, very simple. Ownership in a business. That is all that is. As much as the technicality of it could be, that is all it is, and that is what is most important about it. Second class. Now, the third one is now what we call the fixed income. And what does that mean? Fixed income is an example. There is bonds. And what does that mean? Now, this is when you lend money to somebody, a company, or a government, and you are paid back fixed returns. That is all it means. All it means there is you give a company, a government, or an individual an IOU, and you say, United States, I want to buy the treasury bills of UK. Basically, UK, here you go, take my £100, give me a bond, and let's say the rate of the bond, the rate of return on the bond is 4.8%. What that means there is I'll be paid a fixed income of that particular rate constantly over the agreed term and period. At the end of the term, they will give me back the money I put into it, the money they borrowed me. That is all fixed income means. It means I have £1,000, I have 100 naira, I have $1,000. I buy a share, I borrow the government, I borrow the company. It's called the bond. I give it to them, and they give me an IOU. They owe me. For the money I'm being borrowed out, they'll pay me a return. And that's the interest. Usually they're not that much. The reason is because it's meant to be one of the safest ways of you investing. So 9 out of 10 times, you will get the money you give them back with the interest. So if it's over 5 years, you will get your interest every year till the 5th year. And at the end of the term, they will give you your original money and say, bye, take your money, bye-bye, adios. That is fixed income. That's the third. Now, the fourth one now is real estate. Now, when we talk about real estate, I'm sure we all know what real estates are. There are something they call REITs. That's real estate investment trust, or it could be in landed properties. It could be in buildings. So you can buy a piece of land. You can buy a property. You can actually even buy REITs. What are REITs? That is a group of companies that bought a group of properties, and you buy a stake in that, and you get a return as the property appreciates, basically. So that's what it's called, REITs, and that is real estate. That is, everybody knows that because it's physical. You can see it, you can touch it. So that is the fourth class we have in terms of real estate. And when you talk about real estate, we can go on. You can talk about residential, you can talk about industrial, you can talk about different types. You could talk about farming and on farmland. You could talk about different classes there, but that's property. That is owning. That's your ownership of the physical space. Remember, first one is cash, very liquid. Second one is equity, ownership into a business. Third one is fixed income. You borrow money to somebody, a company, or the government. Fourth one is ownership of a physical, tangible space, real estate, property. The fifth one I'll be talking about there is commodities. And this is ownership of goods, which people use. And some of them are silver, gold, crude oil, copper, to name a few. Those are called commodities. That is the fifth category. Now, there is a sixth one, which is the digital asset. And in terms of this, we're talking about, I'm sure you've all heard about that. The most popular of all of that is Bitcoin. And that is what it's a digital asset. It means it is something you cannot touch. You can't hold it. It's a piece of code. It's a piece of software. It's a piece of code that has value that you've invested into. And that is another rabbit hole. We don't want to go into that. So that sixth class is for digital assets. And those are the different asset classes we have. What that means there is when you have your capital, you want to invest in an asset, you have different options you can decide to invest in. The question is, you ask yourself is, which one? Let's say I have £100,000 and I'm deciding, you know what, I have my emergency funds, I have some savings, this money here, I want to invest it. Which one should I pick? This is where it gets very interesting. See, nobody has a crystal ball. Nobody knows tomorrow. Nobody can predict the future. The only thing we tend to do there is we go in search of past performance and we use that as an indicator to attempt to predict the future performance. That's all we're trying to do. So based on that, we've talked about the classes. Now, the next question there is asset allocation. How do I allocate my capital I want to invest into which assets? How do I allocate them in the different asset classes? That is the million-dollar question. So for you to do that, there are several factors you need to consider. Out of all those factors, the first thing you need to consider is, what is your risk temperament? What am I saying? How much of a risk taker are you? That's really, really crucial. See, all investments, all assets, when you put your money into an asset you invest in, all investments carry an element of risk. Don't let anybody tell you vice versa. Don't let anybody tell you the moment your money leaves your hand like that, it doesn't matter where it goes. An element of risk is already involved. The possibility of that money coming back into your hand is not 100%. Take that to the bank any day. You saving your money in your bank is a risk. Yep, you heard me. Listen again. You taking your money, putting it in a bank is a risk. Let me bust your brains again. Even you putting your money in your wallet and keeping it under your pillow is a risk. Why? There is something called inflation. Inflation is the theft of capital. You want to know what inflation is? How much did you buy a crate of egg in January this year? How much are they selling the crate of egg right now as of today, 27th of August? Please, can anybody tell me in the chat room? How much was a crate of egg in January and how much is a crate of egg now? That's the simplest example of what inflation is. So you taking that money, putting it in your wallet, not even giving it to the bank, is at risk of what? Of inflation. So everywhere you turn, there is a risk involved. So there's nothing called risk-free investment. Any day anybody tells you that, just know that it is MMM. And what does that mean? That means you are being what? You are being scammed. That is all it means. So there is nothing called risk-free investment. Everything carries a risk. Now that you know everything carries a risk, the next question there is, how much of a risk can you take? See, this is the crunch of the matter. See, some of us, we can owe the whole world money and we will sleep and snore perfectly, no wahala. Some of us, we cannot owe somebody a naira. We will be restless. It's just human nature. our level of risk, our risk temperaments are completely different. It also comes with age, but I'll come to that later. So that's the first thing you've got to understand is what is your risk appetite? How much of a risk taker are you? If somebody tells you that, look, if you give me your money could go 100% or could go to zero. What do you do? Some people will say, lie, I ain't doing. I'd rather let inflation eat my money slowly. But some people would think of the upside of imagine me doubling my money, and they'll go with it. Now, we're not talking about ignorance in terms of you just blindly jumping into things because you don't consider that. So the first thing you need to consider is your risk appetite. The second one you need to consider is your age. Why is that important? Do you have enough time to recover? Why am I saying that? See, the market is very cyclical. Over time, we've seen there are booms and busts. That means there are times when things go oh so beautiful, and there are times when every asset class comes tumbling down. But when it goes down again, it goes back up. That's what we call the term the bull market and the bear market. The bull market is when everything is going up. You see that arrow, the green arrow going up, jump, 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 jump. And the bear market is when the boy says there is blood in the market. That means everything is dropping. Yesterday, no, 2 days ago, I was looking at Disney, we all know Disney. I was looking at the shares of the stock markets, the chart of Disney over last, I think, 20 years. And what I saw was it was going up, it reached a peak, and it was coming down like a mountain. That was the graph I saw. I saw a mountain picture. So that means it started well. Anybody who bought into it at the bottom, they took the ride. It went all the way up, and it got to a particular point there, and it's been going down ever since up until yesterday. So the people that jumped in at the top, they'll just be watching their balance. It's actually down almost 63% in the last 2 years or so, give or take. So it's important for you to understand if you are 50, 60, trust me, you don't have enough time, enough mileage left for you to completely recover, or because each cycle is about 10 to 15 years. We have the boom and bust in almost about 10, within 10 to 20 years, there is always a market crash. That is why we had one in 2000, 1999, 2000. The next one we had was we had a slight one in 2008 or 2000. I think we had another one in 2018 thereabouts. So there is always that 10 to 20 year cycle of when everything goes up and everything busts and it starts again. And it's the greed of man. When we're talking about the market, we're talking about men because it's people that makes the market. And one thing you cannot strip out of the market is greed. It is the greed that pumps the market. It is the greed that make that blows it up eventually, and the correction comes in. So you understand your risk temperament. Number two, you understand your age. And number three, what is the purpose? Exactly. What are your investment goals? What is the target? Someone just chatted that in February in Nigeria, $1 was 460 naira. Today, $1 is 800 naira. Now, that is almost 100%. So, if I had 460,000 in January, I had $1,000. If I had the same amount now, I can barely have $600. That is what a lot of factors, including inflation and bad government policies, can actually do to the market and impact on what's on your capital. So there is no safe haven anywhere, but you can mitigate your risk. And the whole purpose of asset allocation is to diversify your risk. What am I saying? That means It's not to put all your eggs in one basket. Imagine a scenario of you putting all your eggs in one basket and you're going and it started raining and you sleep and the egg basket drops on the floor and the egg breaks. You know there is a possibility all the eggs will break. Now, see another scenario whereby you're going and you have 10 eggs. You put one egg in a basket and you're moving one at a time. If you sleep and the egg breaks, one egg is broken, you still have 9 left. That is the whole idea of what? Assets allocation, allocating your assets in different asset classes. See, all of those different asset classes, they have different volatility levels and they have what? They have different risk levels. They all carry risk, but it's quite different. Your cash on cash return, your cash on cash savings account. The risk there is inflation will hit your money. You get more interest. When you need your money, sharp, you can withdraw it. Well, that is if you can withdraw it on time before the bank goes bust. But most of the time, the risk is quite low. In equity, that means stocks and shares. God help you, you bought the right company. If you bought their AOL America, what's it called? AOL.com in 1999, 2000, the share price goes up and boom, it explodes. That is adios, senorita. Your money is gone bye-bye. Completely wiped out. But at the same time, according to statistics, the greatest wealth creating class is being the equity class. Yep, you heard me. Well, up until recently, it's the greatest wealth creation machine, the stocks market. Now, when you now go to fixed deposits, that one is kind of like, it depends on which nation. We know a lot of countries are defaulting on interest payments and even paying back the capital of the loans given to them. That is why you should seek to invest in, if you're going for bonds, invest in, most of the time, understand the credit rating of the nation or the company so that you manage the risk of, if anything is going to go wrong, it's very, very unlikely or mostly unlikely. It's just like it's very unlikely for America to actually default to actually go bankrupt than for, let me pick a nation, than for Lesotho to go bankrupt. I don't mean Lesotho. I just picked another country. It could have been any country actually. Now the next one after that there is real estate. Now this is where you need to be careful in that particular asset class. Real estate is, to me, is one of the safest ones around. I didn't say it's the safest though. Don't quote me. I said for me. The reason is, number one, God has stopped creating land on earth. It is the same land mass we had 5,000 years ago that we have right now. But population keeps increasing. A simple law of demand and supply tells you when the demand for something outweighs the supply, price will go up. So over time, property tends to increase in value. But property is mostly about location, location, location. And it's about buying right. If you can buy any property right, then you're a winner. And when it comes to property, you make your money when you're buying it. You don't make money when you're selling. If you buy and you get a good bargain in a good location at the time of you buying, then over time, even let's say even whatever happens to the market happens to the market, you still have that evidence of that piece of land is mine. Even I bought it for $1 million and it's currently worth 500. I will wait. It's not going anywhere. If I bought stocks and it's one piece of paper, one email that says hello, Coach Mo, the company is gone bust though, the paper becomes worthless. If the market crashes, I can still look at my piece of land, or if it's a house I built, I can still look at the house and say, you know what, my tenants are still paying me rent, though the value of it. So I'm not advocating for you to get into property. I'm just telling you what that class gives you. And then when it comes to commodities, now commodities is something that people consume. Now, commodities as well, it depends on which of them you go for. But let's pick silver and gold. One thing about silver or gold there is they don't tend to appreciate as much. But what they do there is they hold their value mostly. So if you want to go into commodities, you got to be sure of what you're looking for. If you want to preserve some of your wealth, and we all know that the purest form of money is actually is gold and silver, really. And then the last one. In the last 10 years, I'm looking at a chart. I wish I could actually share that with you here if I can find it. And I was looking at the what is it called? I'm looking at the cumulated. Let me check it here if I can see it here at all. Actually, it's let me see if I can see it here. It's actually the not here. Let me see if I can find it. If I can find it, it's okay. It's actually looking at the 10-year compounded annual growth rates for Bitcoin, Tesla, Amazon, Nasdaq. S&P 500 is what we call the Sales and Poor's 500. That means it's an index, a basket of 500 companies in America. Put them in the basket and how they've performed. And the U.S. Treasury, that is the U.S. Treasury bills, the bonds, and then the gold. Let me share this with you. I think this will put things in perspective of what it is we're talking about. Let me try and do that. Okay. I'm struggling to pick that, but sorry, I can't work that some of the time. So according to that, that is what it gives. I will put a piece of information in the chat box now if you can see it here. And this is quite humbling. If you can see this, let me know. And what this tells you there is this gives you a breakdown. The asset classes over the last 10 years, their cumulative that's giving you the what's it called, the compounded annual growth rate basically over the last 10 years of that. You can see that Bitcoin gives you 132.4%. S&P 500 gives us 17.8. Gold gives us 8.3. Emerging markets, that is still part of, in terms of S&P 500, it's part of the equity. Real estate gives us 5.4. And treasury bills gives us 0.3. We all know that you can now see the difference in terms of the different levels of what we have there. And we know that when it comes to Bitcoin can drop 60%, 100% in one day. It's possible. It's happened before. The last bull run, Bitcoin was around $60,000. It went as low as, I think, $19,000 before it started going back up again. So all of these classes, there is a risk involved. Now, what you now do there is how you allocate your asset is very important. Now, this has got to do with understanding your situation, your age, your goal, and your risk temperament, and you break it down into, let's say, 100% of what you want to do. And if you feel, you know what, my age does not allow me to take too much risk, I'm going to go 60% on real estate. And then next thing you say, you know what, I'm going to go 20% on equity. And then you say, I'm going to go 10% on bonds. And then I'm going to go 10% on digital assets. That is 100%. So now, if anything happens to the crypto market and it crashes, you've lost only 10% of your wealth. If anything happens, the government bond 10% is holding tight. You know your real estate property, even if the value goes down, you are still generating the returns that come from it. If anything happens to the stock market, it's only 20% of your wealth. So per time, when things happen to different sectors, your wealth is not completely wiped out. That is the whole point of asset allocation, is you allocating the assets, and you can always review and rebalance your portfolio. And that is the whole point of doing what asset allocation exercise is, how you div out, how you break out your investment portfolio. I've seen people who are quite old, but they're very bullish on a particular narrative. And naturally, we tend to have, based on how we're raised, we tend to have a preference on which of the asset classes we actually prefer. If you've been moving long enough with me, you would know which of the asset classes I prefer. And the reason I prefer that particular asset class there is I can see the coming narrative. I can see that in the way things are moving. See, money likes mobility and speed. Money likes to move. Money doesn't like being stagnant. And money likes speed. That is why you see that the history of money, we started from barter, we went from barter, we went to whereby, we have gold, we went from gold, we went into notes, promissory notes, we have notes. Then from there, we went to checkbooks. Then from checkbooks, we went into um, electronic banking. And at that time also, we had physical cards where we push the card into and we enter the PIN number. After a while, we feel the 3 seconds or 5 seconds is going to take us to actually enter the keypad on the PIN is too long. And then we got contactless. After we got contactless, then before we know it, we have the mobile, the mobile virtual card, whereby we don't even need to now carry that card again. It's actually on our mobile phone. Then it's not got to a point whereby you don't even need your mobile phone. If you have a smartwatch, you have Google Pay or Samsung Pay on your smartwatch. That is what you need to do anything, and you just scan contactless. You can see how things have sped up from just you carrying a pile of gold of wealth to you being able to make payments anywhere if you actually have just your wristwatch with you, which is your smartwatch. And that tells you that now that we are actually in the artificial intelligence age, speed is very, very important. And that tells me we've just been ushered into a different dimension of digital disruption and digital age. And that is why I'm a lot more bullish on digital assets. But don't be fooled, I am also invested in commodities. Don't be fooled, I am also invested in real estate. Don't be fooled, I'm also invested in equity as well and very knowledgeable about them. So it's all about understanding per time your situation. Number 2, understanding your risk temperament. Number 3, understanding, and it could be the volume of cash you have at that point in time, your preference, and most importantly, what's your ultimate goal? See, so most of us, we just want to have a house. It's either it's a symbol status, it's either it's what they've we knew growing up. Property. Everybody wants a house. And some of us, we just want, we just want returns from real estate. So it depends on exactly what your goals are. And some of us, it doesn't matter where we live. It might be a rented house. It might be, as long as there is returns from investments that can fund that level of lifestyle of where we are. Some of us, we don't want to live in a particular location for more than a year. We get bored easily. So what's the point in me buying a house and in a year I want to move out? Some of us is every 6 months. We live in a particular place, we get bored easily and we want to move. So it depends on who you are, and don't let anybody dictate what you want, especially if you're in a position to afford it. Don't. Your choices are not my choices. That is why I will not impose my asset allocation formula on you. That is why I am not giving you one today. Understand the various classes we have. Understand your personal situation, what you have, what's in your pocket, and be very, very literate. Have the basic understanding of how each of these classes work and what the risk they carry. Make informed decisions about how you then allocate your resources into the various classes. And that is all asset allocation is all about, is how you delve, you divide your capital to invest in different asset classes. Find a formula that works for you. Some of us will love stocks and shares. And trust me, you cannot but be interested in that asset class. Why? Because business that creates value will continue to generate returns that are that are insanely humongous. Only a few days ago, just Nvidia alone almost was the only company that kept the market intact because of its crazy return. So don't let the fear of, because and there's something about the mistakes our parents made. They pass on those fears onto us. And we now have those fears in us, and those fears are what are driving us all over the place. And because our parents invested in the bank in any particular part of the world that failed, and they say, when they hear stocks, they run the other way. And it's put that fear is already implanted in us and will run away from. Some people will say, if I cannot see it and touch it with my hands, I cannot invest in it. You are going to miss the greatest wealth transfer ever in this generation, if that's your mentality. Let me ask you one question. You use a phone, don't you? If you use the phone to say hello, have you ever said, okay, not until I see that thing that makes the person on the other side hear me, I'm not going to use the phone? So approach this with pure literacy and understanding of what each of those classes are. One class that still scares everybody like crazy is the digital assets. Some people, because you've lost money, trust me, I don't lose money. I've had some investments that have not paid out well so far. So let me change my words. That have not really paid out so far. I'm telling you, quite a huge number of them in the digital asset space. It does not stop me from saying because that one did not work, it's a bad class. No. It's just like some people who invested in Amazon when Amazon started. Because nobody saw the future of Amazon then, nobody touched it. Because Amazon came at the wake of when the dot-com bubble busted. But the people who were brave enough to see the future got into it and they held on onto that particular asset. And right now they are the ones smiling. So your ability to understand, and please, whatever you do, get knowledge and get the understanding of the asset classes. Maybe sometime before the end of the year, we will actually pick each of those classes and actually break them down, because there's something called diversification. What diversification means there is, we now pick an asset class and say, okay, we are picking equity today. Let us diversify. That means instead of you looking at each of the asset classes in silos, you can actually go into a particular asset class and you diversify. You now go deeper and say, okay, equity, stocks, and shares. Let us now dive deep into that rabbit hole and unpick and see what is in there. And that is when you see things like index fund. You see things like mutual funds. You see things like exchange traded funds. You see things like stocks and shares. You see the things, the S&P 500. You now begin to see all of those various things all within there. And then you now decide, okay, how do I even diversify within a particular asset class? Just like in property, in real estate, when you get into real estate, the question there is, What exactly do you want from real estate? Do you want to buy just land and wait for years? There are people that do that. They buy lands and they just fetch the land round, they get the papers, and they wait for the lands to appreciate over years. And once the land appreciates, they sell the land and they move on. Some buy the land, they build on it, they live on it. Fine. Some buy the land and half of it they rent it out. They buy the land. They build 8 bedroom, eight flats, apartments, on the land. They live in one. They rent out 7. See, they are different. With some buy the land and they have office complex and raise office complex there. Some have industrial estates there. Some get commercial estates and commercial property. Some get a land and they actually build a school on it. So you can see even within real estate, there are various things you can do there. So remember, asset allocation is your ability to diversify your portfolio, manage your risk, and express your preference in terms of investing into different asset classes. So, on that note today, let me go through the chat and see if we have any questions at all. It seems there is no questions at all today. Thank you very much, everyone. It's good to be here today, and then we will see you again at the end of September. It's Coach Mo here from Power to Know. Thank you, and God bless. Have a lovely Sunday.